We'll talk about the results soon. Since 2008, we've been debasing the currency, which is the same thing as making the system bankrupt for everyone. You mean making everyone else's problem when you say mutualizing, right? Yes, that is, economic action is what makes the interest pay off, right? If you don't have a job, you can't pay your bills or mortgage, right? True? And if your debt keeps growing, you need to keep your wages rising so that you can pay off your bills. Now look at the GDP side of things. Labor arbitrage, in which companies send industrial jobs to countries with cheaper labor, is one way that globalization is blamed for widening the wealth gap. This brings down the cost of production and increases earnings for shareholders and asset owners. While these groups did well, middle class people who used to work in these factories lost their jobs and saw their pay stay the same. In an interview with Tom Bellew, Royal Pal talks about how debt cycles and the instability they cause in the economy are a big reason for this growing gap, especially since the 2008 financial crisis. The crisis showed how weak the global financial system is, with people and governments depending more and more on debt to make up for real wages that are staying the same. This change in the economy has made social problems worse, like the opioid crisis, because people who are having a hard time with money and hopelessness turn to drugs, and the social problems that come from it before we can focus on bigger changes to the system. Don't go, it's not possible, don't miss the bull run in 2025. Learn as much as you can before everyone else. We have put together the best step-by-step crypto G guide to help you through this bull run. Find out what crypto is all about and start investing smarter right away. Now click on the link below to get your special copy for a little less than $10. We'll talk about the results soon. The way we've been acting since 2008 is making the system's collapse worse for everyone. By the falling value of money, which is the... You mean making everyone else's problem when you say mutualizing, right? Yes. You can either raise taxes, which is what they're also trying to do, or you can make money through a process called quantitative easing. This debases the currency, which means that when they do it, asset prices seem to go up. They don't really go up, because if you look at the central bank's balance sheet and divide all of its assets by it, you change the denominator. Usually it's as dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars, how many dollars are in the economy, or how many dollars have been printed in excess. You'll see that the SP 500 and real estate gold have both stayed the same, and crypto and technology are the only two investments that have actually done better once the Fed began inflating, or making the denominator less important. It's a 2% growth rate. That's what the government needs to pay its 2% interest. How does that help pay the interest? Because they're just taking in more tax money, that's pretty much it. Right on, right? In order to pay the interest, the economy needs to grow to a certain point. If everyone's interest rates are too high, the first thing that should be done is to make the interest rate as low as possible. This is why the Japanese have a much lower natural rate of interest than everyone else. They owe 260% of their GDP in interest. But their businesses have less debt. In other words, they're stuck. They can't let the interest rate go up because they owe so much money. No one can. We're going to have a slump and cut interest rates back to zero because of this. It can't work, it doesn't. When all of these governments reach 100%, one of four sectors will either blow up: the private sector, the business sector, the corporate sector, or the government sector. Because GDP growth keeps going down, there isn't enough money coming in to pay off that much debt. That is, economic action is what makes the interest pay off. Right? If you don't have a job, you can't pay your bills or mortgage, right? True. And if your debt keeps growing, you need to keep making more money to pay it off. Now look at the GDP side of things. On the other hand, we see that all government debt that is higher than GDP shows up on the balance sheet 3.5 years later. I did the math on this too. I believe I was the first person to really understand this. I checked this out. After 3.5 years, I realized that they were making money off of the interest payments on the loan. Okay, but why 3.5 years? In 2008, there were no interest rates at all. Each and every government should refinance itself at zero. And most of the debt that all countries have is between 3 and 5 years old. That's 3 to 5 years or 3.5 to 4 years. That's because you have to bring down the interest rates every time you pay off the loan. There is a decline in the end though. The thing you get is this very repetitive thing. Because are they putting off having to pay for 3 to 5 years? No one pays back loans. Nobody is ever going to pay back a loan. That's why the next amount of debt always ends up on the Fed balance sheet when it's time to pay it off. Actually, it does happen because of the debt driven slowdown in the economy, but it does. There is also a small change in size. The US, the UK, the EU, and Japan are all the same in this way. The difference between the balance sheets is even bigger. The only difference is that they have to put direct money in whenever there is a direct financial problem. That's something we've already seen a little of in the US. RAOUL says that since the financial crisis of 2008, the world economy has been spreading the cost of failure by letting people file for bankruptcy and debasing currencies. He thinks that governments deal with this in two main ways: by raising taxes and making more money through quantitative easing. When this happens, the currency gets weaker. This makes investments like stocks and real estate look more valuable, even though their real value hasn't gone up when inflation is taken into account. This trend mostly affects younger generations like millennials who started working after the Federal Reserve started doing these things. It makes it harder for them to buy assets like homes and increases the wealth gap between people who own assets and people who don't. RAOUL says that for countries to be able to pay the interest on their debt, the economy has to grow. The economy should grow at a rate of about 2% per year, which would help the government to collect more taxes and pay its interest bills. But as debt and interest payments go up, it becomes more important than ever to keep interest rates low. When governments have a 100% debt to GDP ratio, they could hurt the private sector, the business sector, or the economy as a whole as it tries to keep up with rising debt levels. Because of this, a lot of experts think that the economy will have more problems. Let's listen to the conversation again to learn more about this subject. The Fed's balance sheet is what's really moving the SP 500. That means it's a trick of the eye, it's a money trick. So the price just goes up to keep up with the inflation that making money causes. That's right. The price is being changed again. That's what's going on. So once you know that, and it's 97%, you know that this liquidity is the only thing that counts. That's what I've been trying to say. Sorry, all your economic models are wrong. Yes, you have to guess the business cycle to find out where you are in the cycle of chances of making money. Everything else doesn't matter. That's what drives assets. That's why people are so mad right now. The stock market is going up and they think, don't you know there's a recession? I am aware that more money being printed is the best way to fight decline. Liquidity is driven by what I know. The business cycle is what makes it happen. There are also cycles that look ahead. The Chinese credit cycle is about 18 months or 2 years ahead of the rest of the world. When the economy goes through a boom and bust, also known as a recession and growth, this is called the business cycle. And one thing that central banks do is raise interest rates when the business cycle gets too hot and inflation starts to rise. This tends to slow down the economy. Interest rates would go up on their own even if there wasn't a central bank. I believe that the free market can set interest rates without a central bank. The business then slows down again, and this keeps happening over and over again. The Nasdaq could go up by more than twice as much from here on out. We are about to see another huge crypto run. That's until 2025.